budget, markets are waiting with bated breath to see what the finance minister delivers, especially on taxes. We spoke with top market experts at the Bombay Stock Exchange on their budget expectation. The bottom line is this: no bad news on tax will be good news for Dalal Street. Hear them out.
Looking at some of the other events recently where you had a new regime in the United States which has talked about a very steep tax rate cut. So if US is talking about a 15-20%, I'm sure India will also have to pay attention to it, because that will be followed by several other countries in the world. If you also want to leverage fully on what we have done in terms of the demonetization and everything else to increase the tax to GDP ratio, one is the cutting tax rate, but also simplifying the tax regime. When you talk about the ease of doing business, the ease of calculating and paying your taxes should also be the an important thing.
Aditya, the one thing the markets want, okay, I will allow two things the markets want for this rally to remain hydrated.
The way I see it is the government has taken a big and aggressive political call through demonetization and with GST that is impending. And both of these are disruptive. To some extent, there has been some pushback on that. So I think where the market is being hopeful is that they're looking for some messaging in economic terms, but which will be political in terms of either tax support or some kind of a uniform basic income or something that actually builds on the hard work that has been done. So it's interesting to note that there's been much more reform in the last 6 to 18 months than you've seen at any point in time. The fruits of those reforms are still not effectively playing through, either in economic terms or in terms of the individual feeling so much better. So I think what the expectation is here, to some extent, you massage challenges that you faced, but also try and seek and build on it. So tax would be one of them. Thinking of the uniform basic income could be another one.
The one big negative or the fear for the markets is short-term capital gains. So if that short-term capital gains is increased from, say, 15 to 20%, would that be something that can disrupt this superb cheer that we see?
I think short term, for sure, if you get a tax increase in markets, there will be a short-term reaction. But I think it sort of remains to be seen as to how deep it will be, because market usually will adjust one time for this kind of event. It will not be something it will hang on for a long time, and you cannot see that in sort of isolation alone. For example, if you're going to 25% tax rate, let's say on corporates over a period of time, that is a 5% boost in earnings effectively. So if the tax rationalization is, the entire is part of a gamut of things which makes sense to the market, then I don't think you might see that kind of reaction. Also remember that long term probably is also equally important in terms of tax rates, because effectively by taking out Mauritius Treaty and Singapore Treaty, you essentially have introduced much larger portion of participants in the markets are paying a much larger short-term capital gains, no impact on the market. So the fact is that a bunch of FIIs who are paying no taxes so far are starting to pay taxes, has had no impact on the market. I think a small percentage increase might not sort of alone cause the market to delay.
Okay, 15 to 20 will not disrupt the market. But before I come to Sudhir for more complex questions, Navneet, what if short term is not 1 year but 2 years?
I think if you have a year where economy is growing at 9%, corporate profitability is growing at 15%, markets are doing well, global investors are putting money, domestic investors are quite enthused, that could be a good environment to do that. I think given that in next couple of years, huge amount of divestment needs to happen. And if the market sentiments are not good, global investors, maybe till couple of months back, we were the only oasis of hope for the world. But today, you look around the world, US markets are doing well, UK is doing well despite Brexit. I think this year European equities could do well despite all the political challenges. Some of the other commodity producing countries are doing well. So I think we have to face that competition for the global flows also. So maybe I think it can wait for some more time.